Okay, think about the world of finance, as we know it. It has these really deep-rooted structures, right? Things like how long it takes for a trade to actually settle, that period where your money or asset is kind of in limbo, or just the fact that markets, well, they close. Nights, weekends, holidays. It's a system built over, well, centuries, really designed for a different era. But what if there was a fundamentally different way to handle capital markets?
Yeah, that's exactly the question our source material for this deep dive gets into. We've got documents here from WhiteRock, and they're laying out their vision for what they call a new world.
Hmm.
And specifically, we're looking at a document called Pros versus TradFi, which directly contrasts their proposed white network with this traditional financial system, TradFi as they call it.
Right, TradFi. So our mission for this deep dive is, well, to get straight into that White Rock document. We want to see what they identify as the key advantages of their white network compared to traditional finance. They're proposing a new capital markets platform, and it's explicitly built on blockchain principles.
Exactly. They see this technology as the foundation, really, for disrupting some of those, long-standing structures you just mentioned.
Okay, so let's jump straight into the first big difference they highlight in this document. They kick things off talking about something pretty fundamental: settlement speed. What's the claim there for the white network?
Okay, so they state it offers instant settlement T+0. What's really interesting about their claim is that transactions on the white network are described as being final, like full transfer value, as soon as a block is confirmed on the underlying protocol, which usually takes just seconds.
Seconds. Really? That feels like light years away from the standard T+2 cycle we're used to in most stock or bond markets, where settlement takes 2 full business days after the trade. What's the big deal about shortening that? Why does it matter so much?
Well, the source argues that by eliminating that standard 2-day clearing cycle, the network immediately frees up a really significant amount of capital that would otherwise just be tied up, waiting for settlement to complete.
Ah, right. Think about the sheer volume of trades happening globally. That's capital that just can't be redeployed instantly. And also, they say, drastically reduces counterparty exposure. That's the risk that the other side of the trade might default before settlement is final. That tied up capital and that counterparty risk are just sort of baked into the T+2 system.
Okay, yeah, that makes sense. So faster settlement means more efficient use of capital and less risk just dangling out there. That feels like a pretty fundamental shift. What's the next major difference WhiteRock points to in their comparison?
They move from settlement speed to market access.
Yeah.
They highlight continuous 247 market access for the white network.
So it never closes, like ever. No weekends off, no holidays.
That's the idea, according to their document. The underlying protocol operates around the clock. It completely ignores traditional market hours, public holidays, or, regional time zones.
They make the case that this persistent availability lets institutions, both buyers and sellers, react to global events and, enter or exit positions precisely when it's strategically necessary. It supports investment and trading strategies that are inherently time-sensitive, especially in, well, today's globalized economy.
Yeah, I can definitely see why that's a big deal. If you're managing assets across different continents or need to react instantly to news, waiting for Wall Street or London or Tokyo to open up, maybe days later, that's a huge limitation. Okay, so we've got instant settlement, 24/7 access. What about where the trades actually happen, the venue itself?
Right. This leads them to the concept of a unified global liquidity pool. The source claims that all orders for assets on the white network flow through a single integrated platform that exists on-chain. And this is presented as a really stark contrast to traditional finance, where liquidity for, say, the same asset can be fragmented across tons of different exchanges, dark pools, other trading venues all over the world.
Okay, and putting all the orders into one big pool, how does that actually benefit the users? What's the advantage?
The document suggests several advantages here. First, it enhances price discovery, right? Because all the buy and sell interest is visible in one place. Second, it lowers slippage on large trades. Slippage is, when the price you actually get is worse than you expected because there wasn't enough volume right at your desired price point. With a deeper unified pool, it's theoretically easier to execute those large orders closer to the expected price.
Gotcha.
They also add that this allows market makers to, quote, tighter spreads. That's the difference between the buy and sell price, which ultimately reduces trading costs for everyone involved. And they argue these benefits are incredibly difficult, maybe impossible, to replicate in the traditional sort of siloed infrastructure.
So potentially better prices, smoother execution, especially for significant volume because you're tapping into global demand and supply all at once. Speaking of that traditional infrastructure, what about all the different companies and processes involved in a typical trade?
The middlemen. Yeah, this is where they discuss disintermediation and lower operational cost. They really highlight the role of smart contracts on the white network. The source claims that these automated, self-executing contracts basically replace many layers of traditional intermediaries. Think custodians, clearinghouses, transfer agents, and all the complex, often manual reconciliation processes required between them.
So the smart contracts essentially automate tasks that used to be done by all these separate companies. How does that work in practice?
Well, the idea is that the rules for settlement, asset transfer, or even, say, basic compliance checks are coded directly into the smart contract itself. When the conditions are met, like payment is confirmed on the network, the transfer of the tokenized asset happens automatically, and it's immutable on the ledger.
Okay.
The source claims the streamlining of the whole post-trade lifecycle directly cuts settlement fees, reduces operational risks, the ones associated with manual steps, and significantly shortens the time it takes for both sides, for issuers getting cash for their assets and investors getting the assets for their cash.
That sounds like a pretty direct challenge to a lot of established financial services businesses, doesn't it? What about new types of assets or ownership? Does the white network enable anything different there?
Yes, a major focus for them is the tokenization of real-world assets, or RWA. The source describes the network as enabling a really wide range of assets, things you wouldn't typically find trading easily or digitally today. Stuff like private equity stakes, maybe interest in real estate, or even revenue share agreements. These can be represented as programmable tokens on the network.
So taking something physical or maybe just illiquid and turning it into a digital token that can be traded.
That's the core concept, exactly. They state that each token essentially carries the economic value and the rights of the underlying asset, but it also inherits beneficial characteristics from being on the chain. They mention transparency. The transaction history is verifiable right there. Composability, the ability to potentially link these tokens with other applications or financial instruments, kind of like building blocks, and automated compliance features that can be programmed directly into the token or the smart contract managing it.
Programmable assets.
Huh.
That does open up some new possibilities. Like what, for instance?
Well, building right on that idea, the source points to fractional ownership at scale. Because these digital tokens can be subdivided into many, many tiny units, often down to like 18 decimal places, very high value assets that are traditionally way out of reach for most investors can potentially be issued and traded in really small fractions. They give examples like fractional shares in, say, blue chip private companies, or maybe fractional ownership of prime commercial real estate.
Hmm. Wow. Okay. So instead of needing millions to buy a piece of a big building, you might be able to buy just a tiny sliver of it for, I don't know, $100.
Exactly. Or even less, potentially. The source argues this fractionalization dramatically increases market participation. It allows investors with smaller portfolios to access asset classes that were previously reserved for the very wealthy or, large institutions. And importantly, without altering the fundamental characteristics or the value of the underlying asset itself.
That really could democratize access in a pretty significant way if it works as they describe.
Yeah.
Okay, so once these assets are tokenized and fractionalized, the big question is, can you actually sell them easily? What about liquidity?
And that's their next claimed advantage, secondary liquidity for tokenized RWA. Once these RWA tokens are issued onto the white network, the source says they can trade peer-to-peer on an open, continuous secondary market right there on the network itself.
So not just an initial offering where you buy it from the issuer, but an actual marketplace for investors to sell those tokens to each other later on.
Precisely. They argue this provides investors with crucial exit optionality, basically, the ability to sell when they want to. And it allows for continuous price discovery based on real-time trading activity. For the entities who initially issued the tokens, like the company or the real estate fund, the source claims they benefit too. They get a much wider potential investor base and improved capital efficiency compared to traditional private placements, which are often very illiquid and super difficult for early investors to get out of.
Okay, wow. So pulling all these claimed advantages together, we've got instant settlement, 24/7 global access, a single pool for liquidity, cutting out layers of intermediaries, tokenizing real-world assets, enabling fractional ownership of those assets, and then creating a secondary market for them. That's a pretty comprehensive picture they're painting. How does WhiteRock sort of summarize the overall goal of bringing all these features together?
They state that these features are designed to, and I quote, create a capital markets platform that matches cryptographic finality with the regulatory familiarity expected by traditional finance professionals.
That's a really interesting phrase. Cryptographic finality with regulatory familiarity.
It sounds like they're aiming to blend maybe the technical assurances of blockchain, like irreversible transactions, with the kinds of structures and compliance that traditional financial institutions are used to, that they need to operate within.
That really seems to be the bridge they're trying to build, yes. The source concludes by describing the White Network as aiming to deliver global reach, immediate settlement, and asset programmability in a single, cohesive protocol layer. And they list these key advantages again, essentially reiterating the instant T+0 settlement, the 247 trading, that single global platform, the reduced need for intermediaries, the on-chain tokenization, fractionalized ownership, and the active secondary market for these tokens.
So that's WhiteRock's case for their White Network, pulled straight from their Pros versus TradFi document. It's certainly a vision for a potentially faster, more accessible, and maybe more flexible financial system, all built on this new technology. It definitely lays out a clear argument for how they believe these specific features could fundamentally alter how capital markets function, addressing some of the inherent limitations or maybe just frictions in the current structures.
And understanding this potential shift is really important for you, the listener, because if this kind of model gains traction, if it's successful, it could change quite a lot. Everything from the speed and cost of your transactions to what you can even invest in and how easily you can buy or sell those investments down the road.
It certainly paints a picture of a very different kind of financial ecosystem than the one most people interact with day to day right now.
Absolutely. So it leaves you thinking, right, if these high-value assets, things that were once exclusive, suddenly become fractionalized, available to almost anyone, and they're tradable around the clock 24/7 with money changing hands in mere seconds, how might that fundamentally change not just what people invest in, but how they think about saving for the future, building wealth, or even accessing capital if they're the ones issuing the assets? What stands out to YU listening right now as the biggest potential implication of this kind of system compared to what we have today?